Good morning, everybody, and welcome to InsureTalk14. My name is Nontosugo Mhlungu, and I will be your host for this session. As always, we've got a jam-packed lineup in store for you today. But before we do, it would be remiss of me not to mention the recent events that unfolded in our country in the last couple of days. Coincidentally enough, the theme for InsureTalk13 was food security and the role of insurance in the agricultural sector. Never did we think that just 1 month on we would be experiencing food shortages and that this would be a crisis in our country. However, what has been encouraging is seeing people from different walks of life come together, united in the spirit of Ubuntu, to rebuild our beautiful country. Now, by no means oversimplifying what has transpired, but this has certainly served as the silver lining, and we can only hope that we continue in this vein as a people. All right, back to today's proceedings. Now, as I mentioned, we've got a jam-packed lineup in store for you. The agenda is coming up on your screen right now. These are the speakers. These are the topics that you can look forward to, so do make sure that you stay on until the very end of the session. Discovery coming on board as a headline sponsor for InsureTalk14 for the very first time, might I add. We are excited to have Discovery on board, and a huge thank you to you, Discovery, for being the headline sponsor for this session. Our other event partners today include Cover Magazine coming on board as our media partner, as well as the IISA, who have assisted with the accreditation of the session for 2.5 CPD hours, so you can look forward to that as well. All right, I think I've said enough. I think let's just jump right into it. But before I do, I'm told we have more than 1,100 attendees online today. That is truly phenomenal. So huge thank you to all of you at home for your continued support of InsureTalk. Let's get right into it. I hope that you are comfortable and warm. It is a bit of a chilly morning today, so I'm going to introduce our very first speaker. He goes by the name of Seamus Cassidy. He's no stranger to the industry. Seamus is the CEO of Lockton South Africa, and he's going to be talking to us today about corporate account trends, as well as the recent riots and COVID-19 claims. Over to you, Seamus.
Thanks very much, and good morning to everybody on this freezing cold morning. And you know, I've got the task of talking about corporate trends in insurance and what's happening, and then I'll sort of list an experience of the COVID claims plus the SASRIA, the recent civil commotion claims that have taken place. But I think before I do that, my bio is somewhere in the works. I don't know where it is, but whatever it is, I've had about 40 odd years, mainly in the corporate space. And therefore, I believe that I have a reasonable grasp of the sort of coverage that an insured a client would expect, and therefore believe that I'm okay in talking about these topics. But by no means, and what I say perfect, because I can't explain necessarily why I've taken a particular course or taken a particular stance on the matter. But suffice to say that I'll be talking about general issues and not specific account issues, and general issues related to corporate and corporate insurance. Okay, I've made a couple of notes. So excuse me, please, if I occasionally look to the side, because I'm trying to refresh my memory. At my age, I need as much help as I can get. I think the most fundamental point that I would like to raise with everybody is that you need to talk to your client. You need to establish very clearly what the expectation of that client is related to his insurance policy. Very often we hear of massive disappointment. The insurance industry has failed. The policy doesn't cover what I wanted it to cover. The payout is nowhere near what I expected. And mainly that's because clients do not understand what it is. And we as brokers and insurers, for that matter, don't explain to our customers exactly how the policy will work. And if I may dispel a myth, everybody says that business interruption insurance is designed to put you in the position that you were before the fire or before the loss, and including trends and whatever. That's an absolute myth. I've yet to see an insurance policy, a BI insurance policy, that puts you in exactly the same position as you would have been. It is far better for a business to continue trading than it is to have an insurance claim that interrupts matters. because there are very, very, very few occasions where an insured has ended up in exactly the same position as we would have been, but for the event. Okay, but for the insured event. Okay, so the prime message that I'd really like to leave everybody with is please make sure your clients understand what it is that you're trying to do on their behalf. Remember, please, as well, that the insurance policy is a contract between the insurer and the client. It is enforceable at law if it's been issued correctly. And as brokers, we are advisors to the client to aid that client in getting that contract, the insurance policy, the contract to work as the client would like it to work. Now, in a lot of instances, we just use muscle memory. That's the way we've always done it, and therefore it's okay and everything's fine. And the policy will respond appropriately. However, when the claim occurs, and remember we deal with fortuity, it means the claim may never occur. But if it occurs, the insured or the client has the right to expect reasonable response from the insurer. And that reasonable response is governed by the insurance policy that's issued. And if that doesn't satisfy the client's expectation or satisfy the event that has occurred, there will be dissatisfaction, and the industry suffers as a result of that. So I'm blaming everybody, myself included, where we do not necessarily fulfill and we do not necessarily record and convert into the policy document the actual expectations of the client. And I'm sure I'm speaking for everybody when I talk about that. The big issue is that whatever we do and whatever we put into play needs to be adaptable. Now, we're dealing with an insurance policy developed when 1950s, perhaps, business interruption, maybe, 70s. But we're dealing with 2021. And there's been massive, massive, massive change in the way industries operate, in the just-in-time stock holdings that people maintain, in the use of technology, in the use of AI, in the use of technology to assist the businesses in producing more and more. And our policies are 50 years out of date, in my view. So if we don't actually adapt the basis of those coverages, we are always going to be limiting the payout and the experience of the customer. And there shouldn't be problems. We deal with a 0% of a value insured. A 0%, it's not big money. The only time it's big money is, I think, in the renewable energy space, where once you've built the plant, insurance is probably about the third largest cost that you have. But that's renewable energy. In the bulk of our businesses, processes, retail stores, etc., insurance is quite minor. And therefore, to do the right thing and increase the value by X or Y or Z actually does not cost a lot of money for the particular client. Okay. So automation is the one issue which our policies don't deal with particularly well. And I'll use automation in warehousing context. We've got a fully automated warehouse. It does stock picking. It sends these robots up to the 12th story to collect a particular item, puts it, packages it sometimes, puts it on a conveyor belt, and it comes out in the retail store. The salesperson takes it, gives it to the customer pays, etc., etc. Now, which insurance policy deals with the exposure that the electronic picking and the electronic operations of that warehouse does? Sure, there are cost savings and all of that sort of stuff. But which insurance policy deals with that electronic process? Well, think about equipment that is used to manufacture, that is now so electronic, it does things automatically. It can be programmed from the office. It can be programmed from somebody sitting behind a computer. Now, do we insure that as a fire risk, or do we insure that as an electronic equipment risk? What happens if there is a cyber attack And my ability to perform and my ability to run that business is impaired as a result of that. So the challenge for you and all of people advising clients is that we have to do the right thing. We've got to talk to our clients and find out what dependency they have. It is far better to have fire, in my view anyhow, to have fire cover, but it's limited. Doesn't cover the breakdown of the equipment necessarily, unless you're being specific in that regard. So therefore, business interruption as a result of that breakdown. What about cyber? Well, I don't think it's going to be too long before we have cyber exclusion on most policies. And I'm including liability in that space as well. Now, as stupid as that may be, because if I incur a liability in a corporate space, surely I would want to incur a liability as a result of cyber attack as well. But be that as it may, we'll wait and see what happens in the insurer space, in the reinsurer space going forward. So automation is a massive, massive, massive issue. There is not a single industry that I know of that hasn't gone through automation. Look at the retail industry. We're all buying from Takealot. How did Takealot deal with their risk? I don't know. They're not clients of ours, so I really don't know. But they have to have massive automation. And therefore, it's not the warehouse fire that is their biggest exposure. It is probably the lack of ability to automatically tell their suppliers that Joe Bloggs has bought a particular item. How do we deal with that in terms of a current assets policy, as I said, developed in the 50s, 60s, maybe the 70s? Okay. Values. I may just dwell on that for a second because it is the main driver of premiums. So there's always pressure on values. What do we do? What don't we do? What do we include? What don't we include? Be very specific is all that I can advise everybody. Please be very, very, very specific. If you don't want reinstatement cover for a particular category of item, specify that in the policy. Be clear that you don't want that. Make sure that your client knows that he's not getting replacement value for that particular item as well. Then the question of VAT comes to play. Certain policies that we would initially exclude VAT from the values declared. But every policy issued by an insurance company has VAT as an inclusive requirement. Be very clear about what your policy says and what you tell your client to include or not include. The bulk of issues that I come across as a witness in various cases that occur from time to time, the bulk of the issues are failure on the part of the intermediary to advise the client correctly about the terms of the policy, VAT inclusive or not. So you don't want a 15% underinsurance for value because average will certainly apply in that case. And the client will certainly be disappointed about the outcome when they're expecting. So we need to be specific about VAT. We need to be specific about stuff that we would and should know as citizens of the country. Okay, then I'd like to just dwell very briefly on sublimits. And I'll cover BI in a second because that in itself is a topic. Sublimits are generally in addition to the limits that apply. Generally, in addition, we need to be specific. If you produce a summary for your customers, make sure that your summary records whether it's in addition or part of the indemnity. Okay. The client needs to understand what those sublimits are. They need to participate and they need to say that they're happy with those particular sublimits when they apply. And the reason for that is quite simple. Disappointment again when the claim occurs. Sublimits, and by the way, there are a number of policies for COVID claims, which I'll deal with in a second, that in fact do not have sublimits for COVID. You may say that's a bit stupid. Well, maybe it is. Maybe it's a drafting error. But the reality is insurers have signed those contracts and we therefore have full value as a result of a COVID claim. Now, that is very, very, very unusual, and I would submit that it's probably an error on the part of the broker, and it's probably an error on the part of the insurance company accepting that. Okay. And then the final point I'd just like to make is do not believe that the perils that you can insure your customer for today are the only perils that it's possible to insure your customers for. I use parametric as a case in point. Parametric insurance talks about an event that is measurable by a third party that occurs, and on the occurrence of that, a certain amount of money is paid. It's quite expensive, but what you may be able to do, and I use a very simple example, earthquake in California. You know that it's going to happen at some point in time, you pay your premium, but you get your $50 million when the earthquake above Richter scale X occurs. You get your payment when a windstorm occurs where the wind speed is in excess of X. You get your payment where the rainfall is in excess of X. But it is expensive and it requires time and whatever. But parametric is probably the most fundamental change that has taken place in the insurance industry. And there are very, very few insurers that are prepared to grant it or have the skills to price it. And the FSCA is currently looking at whether parametric is in fact an insurance product or not. Is it gambling or is it whatever? But I'm pretty certain that it's here to stay. So if I am a motor assembly plant and there's an earthquake in Japan and I import X of my components from Japan, I would argue that I'd probably want a parametric policy payable in South Africa that pays me the $50 million or rands or whatever it may be to enable me to create businesses that produce those spares for me to continue operation. It's far better than having a business interruption claim. You may still have one, but far better to have it as a business interruption claim with all of that sort of nonsense than to have a parametric where you can take some money and go to certain producers and say to them, guys, I want you to produce brake pads for me, please. You're currently producing brake pads. I want you to produce them for my particular model. Surely that's a better outcome. And not only does it benefit the country and the employment and whatever, but it probably shortens the business interruption period for that particular supplier as well. Okay, business interruption. Yeah, the rule of thumb that I try and get clients to do is to quantify their disaster recovery plan. What will they do if they lose that shop? What will they do if they lose the production facility? And what is the likely cost thereof? Are they going to transfer it to an alternative place? Will they go to a competitor and ask that competitor to supply them obviously at a premium covered by the insurance policy, hopefully if you've got increasing cost of working, et cetera, et cetera. So what are they going to do with their disaster recovery plan? Once you know that, you are then able to determine what appropriate output that the insurance policy business interruption needs to have. You need to conduct an extract from the financials, and you need to extrapolate that extract to make sure that you're insuring it for the correct time. And the insurers allow you to do that. They will charge you a deposit premium on condition that you're prepared to disclose at the end of the period and do the adjustment, etc. But they create the mechanism for brokers, for insurers, for clients to in fact insure correctly as far as stock is concerned and as far as business interruption is concerned. They provide that opportunity to you. The rule of thumb that I use generally when I do an extract is the discussion I have with the client is, does this look like your net profit plus standing costs, plus your fixed costs? Does that look as though it will satisfy that criteria? Not that that's the way we do it, but that's the rule of thumb that I use in order to check to do a sanity check with the clients. Net profit plus standing charges, and that will tell you whether you're on the right track or not. But to do an extract, there are plenty of tools around that to assist you in doing it, and it takes almost no time at all once you know your way around the financials. But certain clients are not prepared to let you see the financials. If that's the case, record it in writing. Record it that the extraction of the numbers and the calculation of the insured values, etc., come from the client, not from you. Okay, there is an expectation that brokers produce an extract, but that's not necessarily the case. And also, if you understand the DRP and you quantify the DRP and you know what the client's going to be doing related to a disaster that impacts on his business, maybe they don't need gross profit cover at all. Maybe the basis of cover that they need is, for example, gross rentals. Maybe it's only increase in cost of working, et cetera, et cetera. So please, if you quantify the DRP and you understand it and the client has spent enough time on that DRP, you will know exactly how to insure your client's business interruption. Okay, I'm just conscious of time. So if I may then just dwell very briefly on the COVID claims. As you've seen from various notifications from various insurers, there's a hard deadline where insurers are now looking for the final submission of the claim to take place by the end of August. What it means is that the loss adjuster will have had to quantify the loss, such as it is, would have had to record it, and would have had to submit that to the insurance company by the end of August. Now, that's one or two insurers are applying that sort of discipline, others are not. But in fairness to the insurer and in fairness to your client, you do need to quantify the COVID loss, the interruption that has taken place as a result of COVID. Now, that is one question where contingent business interruption generally has sublimits. And if you've only got to look at the sort of debate in the tourism industry, the sublimits were subject to a different indemnity period, and that's the subject of a court case that some of them are going through in the Western Cape High Court. It's merely to get clarity, but I've seen the schedule of that particular matter, and there is a very clear indemnity period of 3 months, whereas the insured is insisting that, and the brokers are insisting that the full indemnity period of 18 months should apply. Okay, the courts will settle that matter in due course, and I've no doubt that the attorneys are probably making quite a lot of money out of that court presentation. But if you have not disclosed your CBI limits or sublimits to your insured, you can expect them to be disappointed. They've had to shut down for a considerable period of time, longer than I ever thought was possible. And I did think that COVID was probably a 3-month issue and we'll be back to normal in the middle of 2020. Clearly, that has not been the case at all. So, CBI and sublimits, please clarify those. Make sure that your client understands what those limitations are, because it's a hard cap. You can't, and does it include that or doesn't it include that? That's the policy wording. That'll tell you that. A lot of policies we issue don't include that, as I mentioned earlier, but make sure that the claims clause, when the claim is paid, includes that, because that's a neutral position for insurers. They don't need to have VAT in the numbers and charge a premium on VAT, on the VAT portion of the sum insured, when in fact you can avoid it. And that's typically what we would do. Okay. So the policy drafting is absolutely crucial. There are many, many areas that I've seen where there's a debate between the insurer, the insured, the broker as to exactly what the intention was. Was it supposed to be 3 months? Was it supposed to be 18 months? Massive difference between the two. The one claim that I'm involved with as a witness, the indemnity period is 18 months, and the insurers are insisting on the CBI indemnity period of 3 months. Big difference. 90 million rand difference. So I don't know where that one's going to end. I'm not competent to talk legally about matters, and I'll leave that to the attorneys. But from an insurance perspective, the error was in the drafting of the policy wording. So please be very, very, very cautious about that. And then the final point is what's happened in KZN and Gauteng. And I don't know how many of you have signed in from those particular regions, but suffice to say, SASRIA have said, whatever the event was that happened, you've triggered the peril already. Civil commotion peril has been triggered. I suspect there may be a debate if you're in Hope Town in the Northern Cape as to whether there was a civil commotion there or not. But suffice to say, shopping malls, warehouses, stuff like that were targeted, and the civil commotion debate is not a debate any longer, certainly not with Sasria. So that's pretty good news. So please, guys, notify your claims to the agent, which is the insurance company issuing the contract. They will in turn deal with the Sasria component thereof. As you've seen, they want to fast-track certain claims. Those claims under $50,000. Those will be fast-tracked by the underwriters themselves, by the insurers themselves, and then they'll recover from Sasria. Has Sasria got enough money? Well, we don't know. There was an article in the paper today saying that Treasury, I think it was in Daily Maverick, saying that Treasury will bail Sasria out. However, when you're looking at the financials for Sasria, please remember they have reinsurance. They've probably got a reinstatement. I don't know how much they take net, but remember how reinsurance works. You can choose where you want to apply your reinsurance to maximize the recovery from the reinsurers. And by the way, if you look at the published accounts, they in fact have the names of the reinsurers who lead the program, and all the big names that you would recognize are present. So I've got very little doubt that if you were insured and you had a Sasria coupon, that it is likely that you will get indemnity. Remember, please, CBI does not apply to Sasria. You either have to have damage on your premises to qualify for a business interruption. You've got to choose business interruption as part of the coupon, and you've got to have it issued correctly. So please, if I may encourage everybody, have a look at those coupons. It does not necessarily follow the underlying policy with an insurance company. It may be different. So please have a look at it. It, for example, requires VAT to be added to its sums insured. It doesn't matter what the underlying policy says, but Sasria requires it. You don't get CBI, you need physical damage. So there are a whole bunch of issues where Sasria is different, and therefore be very, very, very cautious in the advice that you give to your customers. However, the most difficult portion, I think, is the triggering of the perils, and Cedric Lusonda has confirmed that those perils have been triggered. Okay. Please consult with your loss adjusters. They're going to be making hay. I think the fees are going to be quite significant, but be that as it may. Use the loss adjusters and use them to make sure that you comply with all the terms of the Sasria coupon. So check, please, if I may, that the coupon's been issued correctly. If it hasn't, it's too late. You're going to have to deal with the consequence thereof. Okay. I'd like to conclude on that note, if I may, because I think I've just exhausted the time in any event. Okay. I think there are a couple of questions. I need to look at whether Llewellyn has sent me anything. It doesn't appear so. So if there are any questions, I'll certainly respond to each of them if you use the chat box, and I'll respond to whatever questions generically, and via CN&CO. We'll have a list of all the participants, and I'll make sure that everybody gets a response. Thanks, guys. Cheers.
Thank you so much for that insightful presentation, Seamus. Thoroughly enjoyed it. And of course, for providing clarity and shedding light regarding claims as they pertain to the recent riots. We do appreciate it. All right, before we head on over to our next speaker, just a reminder that InsureTech is taking place on the 27th and 28th of July. So do make sure that you register. We are posting the link in the chat box. If you do want to attend that, it is free. Make sure that you register yourself today. All right, our next speaker now is Bheki Mahlobo. He is an analyst and economic researcher, at the Center for Risk Analysis. And he's going to be talking to us today around business unusual. Without any further ado, then it is over to you, Bheki Mahlobo.
Thank you so much. Let me just share my screen here so that everyone can see it. 2 seconds. There we go. Let me just get the laser pointer here. Good morning, everyone. My name is Begum Mahlobo, analyst and economic researcher at the Center for Risk Analysis. The CRA is a risk advisory think tank that looks at data and provides analysis as to the social economic standing of South Africa and flags risk that the country faces, as well as emerging other and developed markets, so that nothing catches you by surprise in the context that we live in on a daily basis. And I welcome you to the presentation titled Business Unusual. And I think this is quite a fitting title given what we have experienced over the past week. And the webinar is titled of the latest offering from the CRA, a report that was published earlier this month under the same title that looks at business activity in the country and flags the risk that average businesses face on a daily basis in the South African context. And what are those risks? Well, three themes then start to. The first one is that of the business environment. Where are you positioned in the South African context? What's happening to your suppliers? What's happening to your competitors? The second is that of infrastructure, which we answer in this webinar through the electricity question. And third of which is labor risks. South Africa is currently experiencing an unemployment crisis, which poses a major risks on businesses today, a topic I will discuss during the course of this webinar. We answer these three themes in 5 sections, starting with the business section, business environment, all the way until labor risks. So let us get on the way. On our first slide, looking at the business environment, business activity in the country has been on a great decline over the past 10 years. And we gauge this by looking at the change in the number of enterprises by industry from 2009 until 2019. And what will immediately strike the eye is that mining and quarrying industries have seen a 22.9% increase in the number of enterprises, as well as electricity, gas, and water supply, an increase of 40.5%. However, a great majority of enterprises in the country have seen massive declines in their respective industries, such as that of forestry and fishing, a decline of 19.2%, construction, a decline of 3.8%, trade, a decline of 20.6%, and a massive decline in financial and mediation, real estate, and other business services, a decline of 51.9%. All the way to the figure that you see on your screen here for overall industries, a great decline of 30.1%. And the contributing factor to this massive decline that you see on your screens here is largely due to the decade-long of hostile policies that's been implemented by the ruling government that negatively impacts the daily operations of businesses in South Africa. Another factor that needs to be considered is the consolidation by businesses, so that has also contributed to the declines that you see on your screens. That's the picture before COVID-19 and the year that was 2020. What happened in 2020, and is there a recovery afterwards? Well, we gauge this by looking at the Business Debt Risk Index from the first quarter of 2014 until the first quarter of this year. And the indicator states that conditions are improving when the indicator is above the 0 level line, which we show as a black line from the left-hand side of your screen all the way to the right-hand side of your screen. And conditions, financial conditions in businesses did improve in 2017 as well as that of 2018, which you can see as a red line being above that the 0 level line. Subsequent to that period, and due to the COVID-19 pandemic, we've seen a massive decline in the indicator all the way to the second quarter of last year, suggesting that businesses face massive severe financial constraints. Subsequent after that period, we've seen a recovery in the indicator to where its current levels are today. What concerns us here is that the indicator is not showing signs of recovery past that of the 0 level line, and instead is showing a flat line trajectory, suggesting to us that businesses, even after coming off the COVID-19 pandemic, face severe financial constraints. So what does that mean in terms of business activity and as well as liquidations? Unfortunately, it's an increase in liquidations, which we gauge by looking at the change in the number. This is the absolute value of liquidations by industry from January and May of last year, as well as this year. And what you'll see is that industries such as trade, catering, and accommodation were absolutely smashed, with 64 liquidations that were recorded in that time period, as well as that of finance, insurance, real estate, and business services, with 75 liquidations in that period. Not all industries have witnessed an increase in liquidations, such as that of mining, due to the commodity rally that we saw mid last year to where we find ourselves today, a point I'll revisit further during the course of this presentation. I lead you to this figure that you see here in total liquidations for the time period, of which 236 liquidations were recorded. This is a significant factor as it indicates that there's been a decline in business activity in the country in the short term. So that leads us to gauge the sentiment of businesses as well as households as to what do they perceive will be the future economic outlook of South Africa. And we start off by looking at the South African Chamber of Commerce Business Confidence Indicator from 1985 until where we find ourselves in today. And the indicator did recover from its lowest point as of last year of 70.5 points to where it currently sits at 97 points. However, this recovery that you see here, this increase that you see here, is not signifying any substantial increase in business activity in the country, as not largely due to the low base effect of last year, as well as the decade-long of state capture years that this figure is now recovering from. The indicator is still well below its peak in April of 2006 at 140.6 point, a time of which South Africa experienced high levels of economic growth. What concerns us here is this great decline that you see on your screens here, and the indicator showing no signs of reaching its previous peaks, suggesting to us that the long-term perspective of businesses in South Africa is unfortunately that of a pessimistic outlook in the South African economy. We see a similar pattern when gauging consumer sentiment, where we've seen the indicator recover from last year to where it currently finds itself in today. However, a great concern is this decline that you see on your screen here, coming off, firstly, the suspension of the COVID-19 support grant and rising food and fuel prices, which squeezes poor households. This is an environment that I flag for you today, foments an environment of populism from the ruling government that will negatively impact the daily operations of businesses in South Africa. So then what has led to the short-term increase in business activity as well as business sentiment? Well, it's largely due to the commodity rally which we saw as of last year, all the way to where we find ourselves with. And we represent this data by looking at the gold price from 2005 until this year. South Africa's export, although to a less extent today, are predominantly made up of commodities. So whenever we see an increase in commodity prices, that's accompanied by an appreciation of the rand, which you can see here from where the rand has appreciated from 18 rand to the dollar to 14 rand. Now, what's increasingly being brought to question is South Africa's ability to actually extract the minerals off the ground, largely because of before the violent protests that we saw as of last week, there was a report in the media of a mining executive being executed, which brings to question whether South Africa's future ability to actually extract these minerals, which will negatively impact the South African economic outlook in the years ahead. So the short-term outlook is that of a recovery, a short-term positive outlook in recovery. What is the long-term perspective in South Africa? Unfortunately, it is that of economic stagnation. We gauge that by looking at the real GDP growth of South Africa, as well as the South African lead indicator from 1960 until this year. This figure that you see here is projection by the SARB, and it comes off the low base of the negative 7% decline of last year. The trend line of the lead indicator is very important. Every peak with the lead indicator corresponds with a peak in economic performance in the country, and every decline in the lead indicator in this trend line corresponds with a massive declines in the lead indicator. What concerns us is that from the period 2009, the lead indicator has been on its flatline trajectory since its inception in 1960, suggesting to us that South Africa is heading towards a period of economic stagnation where we'll experience high levels of unemployment, low levels of disposable income, and unfortunately a decline in business activity in the absence of fundamental reforms. Further collaboration of this is the electricity question, which we gauge by gauging the generation capacity of Eskom, weekly generation capacity of Eskom from the third week of last year all the way where we find ourselves in today. The indicator is broken up into 4 factors that make up roughly 100%. The first of which is the energy availability factor, which you see as the red bar on your screen. The planned outage factor, this is the maintenance that Eskom does. The energy availability factor is what proportion of electricity Eskom generates and sends out to the South African economy. unplanned outreach factor, these are your breakdowns in power stations around the country, as well as other outreach factors. With the energy availability factor, this indicator should be increased moderately over the recent weeks and should maintain its current levels. And that's exactly what you've seen when looking at the year trend from last year all the way until this year. The indicator has been above that of 60%, which is a great thing that we're seeing under the new leadership of Eskom. In terms of maintenance of Eskom's power station, we've seen an increase in the maintenance capacity of Eskom, which you gauge as the orange bar on your screen in front of you, which is also a great thing that we've noted from Eskom. Another great thing that we've noticed is the reduction in debt. Over 18 months, we've seen a massive reduction in debt levels in Eskom. What concerns us the breakdowns in Eskom should decline in the following weeks, and that's not an indicator that we've seen decline in recent weeks. So the short-term perspective is that of moderate improvements in Eskom's capacity. What is the long-term perspective? And we gauge that by looking at the same indicators, energy availability factor and unplanned outreach factor from 2011 until this year. And unfortunately, the picture is quite dire. As of 2011, the energy availability factor of Eskom has declined from a massive extent from 84.6% to where it currently is at 62%. And breakdowns around the country has massively increased from 6% all the way until 24%. This is a major factor that needs to be factored in your planning and puts a limit on the production capacity of businesses in the country. Further collaboration of the decline in business activity as well as the decline in economic activity in the country is that of the finance minister. His projection of the year 2023 of 1.6%, the lowest economic figure ever put on paper by a national treasury figure. Now, that leads us to actually gauge what happened as of last week. And we gauge this by looking at the protest action in South Africa. What happened last week was not an insurrection. It was not a coup d'etat that was mentioned by the current administration. Over the past 18 months, we at the Center for Risk Analysis have flagged on 7 occasions socioeconomic declines that have led to the protest action that you saw as of last week. And we think the fundamental reasons of the protest actions that you saw last week will not be addressed by the current administration. And how do we gauge that? We gauge that by looking at the real GDP per head and the number of violent protests in South Africa from 1994 until 2020. Real GDP per head is the value of goods produced in South Africa and divided by the population in the country. And the trend that we see is as follows. During the period in South Africa's early years of democracy, from 1994 until 2007, South Africa was growing at levels 3 to 5% of GDP. That translated to improvement in living standards in the country, which we can see as the GDP per head has increased, where people were essentially improving, the standards of living were improving. Subsequent to that period, we've seen a stagnation after the financial crisis, as well as the leading up to the years of Jacob Zuma, as well as that of Ramaphosa, and a massive decline in the year 2020, largely due to the COVID-19 pandemic. Now, with living standards being on the decline, this translates to protest action being on a massive increase. And that's exactly what we see here. In the early years of South Africa's democracy, when living standards were improving in the country, you saw a flatlining in the number of violent protests in the country. Subsequent to that period, from 2007 to 2019, you saw a massive increase in protest action, in fact, of about 400%. What happened last week is not the first time that this has happened in South Africa. It's the first time that it has occurred at the scale, but protest action in terms of service delivery occurs on a daily basis in the South African context, to a point where it doesn't even make it on media headlines. And unfortunately, the reasons because of this is the stagnation of living standards in the country, as well as that of massive declines of it, which you can see in the figure of 2020, where GDP per head levels are lowest level are lower than that of 2007. So the simple answer to what we saw last week is that firstly, people are losing jobs, they're losing income. So how does that translate to ANC voter support? We gauge this by looking at the number of people employed and ANC voter support from 1994 until 2021. And during that period where South Africa was growing, there were high levels of economic growth. South Africa doubled the number of people employed in the country from 1994 until 2007, where the figure went from 8 million to about 14 million people employed in South Africa under the leadership of Nelson Mandela and that of Thabo Mbeki. Subsequent to that period, we've seen a stagnation of the number of people employed and a massive decline in the COVID-19 pandemic and a slight recovery in the first quarter of this year. This figure that you see here is not a substantial increase or recovery from the figure of that when Thabo Mbeki left office in 2008. How does that translate to ANC voter support? Unfortunately, with decline in living standards, it translates to a decline in ANC voter support as people are not inclined to support the ruling government as their living conditions are on a great decline. And we can see this with the ANC voter support, which you read on the right-hand axis as the red dots on your screen here. During times when people were getting jobs, people were getting employment, ANC voter support increased to its highest levels under the leadership of Thabo Mbeki, and a subsequent decline after that, after employment levels started to decline in the country. So then there are multiple of things that I've mentioned. The first one is that the long-term perspective of business activity in the absence of reforms is that of a decline and economic stagnation. How does that translate to the labor concern facing the country? Well, we gauge that by looking at the official and expanded number of people unemployed in South Africa from 1994 until the first quarter of this year. In absolute figure, the black line that you see on your screen here, this is the official unemployment rate. And in absolute terms, South Africa has the highest number of people unemployed since 1994 with its current figures. And we see the same trend with the expanded number of people unemployed, sitting at about 11.4 million people from 3.6 million people in 1994. The difference between the official and the expanded definition is that the expanded definition includes discouraged work seekers. These are people that have given up seeking employment in the country. And this is a dangerous risk that we flag for you today, that a great majority of South Africans are giving up the aspiration of employment in the country, largely due to employment opportunities being on a great decline in the country. So what are the risks of that? What are the risks from a business perspective, as well as insurance companies? Unfortunately, with a youth unemployment rate of about 75%, that is accompanied by high levels of crimes, the likes of which we have seen as of last week. As people become hungry, the living standards decline, it fans the flames of desperation and lawlessness in the country, which puts an extra costs on businesses in terms of security measures that they need to follow in order to prevent these shops from being looted and burned. Now, as much as South Africa is going through the unemployment crisis that we're currently facing, this does offer opportunities for businesses in terms of being able to tap into the large surplus of labor in the country. What prevents this then? Unfortunately, it is South Africa's stringent labor policies, which we gauge by looking at the average level of wage settlement and the inflation level from 2005 until 2021, which we've been privileged to have access to this data from Andrew Levy employment publications. Because of South Africa's stringent labor policies, it results in wage levels being about 2 to 3% above that of inflation, resulting in businesses being unable to employ new employment, largely due to labor being expensive in the country. What is the consequence of that? The consequence of that, unfortunately, is South Africa's low employment levels when compared to developed as well as other emerging. What you're looking at on your screen here includes for selected countries. Employment rates is the proportion of working age population in South Africa that are employed. And South Africa's near 40% employment levels are far below in what we see in emerging markets, such as Mexico, near 60%, and extremely low compared to developed markets such as that of the United Kingdom. And what you see on your screens here, unfortunately, it's the stringent labor policies that prevent new laborers that prevents people from being employed in the labor market. And the consequence of that, unfortunately, is that if people don't have jobs, they can't get an income, which results in a decline in disposable income levels in the country, meaning that consumers cannot buy the goods produced by businesses in the country. That leads us to key risks that we flag for you today. The first one is as follows. Although there's been a short-term recovery in the sentiment of businesses, the long-term outlook in the absence of fundamental reforms in the country is economic stagnation. Therefore, South Africa will only be able to grow at only a fraction of what we see in other emerging markets. And we believe that the underlying socio-economic stances of the protests that we saw as of last week will not be addressed by the ruling government, coming off what we currently see, the statements made in recent days. Therefore, we'll see an increase in violent actions in the country, largely due to the fact that these issues will not be addressed, meaning that we'll see an increase, and unfortunately in later years, at a larger scale than what we saw last week, with more spikes occurring in future weeks ahead. We still believe that Eskom will still be a key concern for businesses, putting a limit on the production capacity of businesses, as well as a cap on GDP performance in the country. And the last point that I make for you today is that in the absence of fundamental reform, we expect South Africa to continue, unfortunately, on its flatline trajectory. The good news that I would like to flag for you and just like to add on to the presentation is that a great majority of South Africans are actually hardworking individuals. The most pressing issue on the South African's mind is employment and the ability to get a job in order to sustain themselves and their families. Unfortunately, the policy environment that consumers and households, as well as businesses, find themselves today in the context of South Africa is not conducive to high levels of economic growth and high levels of disposable income levels. Unfortunately, because of that, what we flagged for you in the later years is South Africa's low growth levels, high crime levels, and this issue will not be addressed in the later years. There's a lot that we do before I close out. There's a lot that we do at the Center for Risk Analysis. We write reports in a printed format, as well as our weekly podcasts exclusively for CRA products, for CRA clients. We also provide research support where we answer any form of questions that you may ask us. Some of you on this call may already be premium clients of us. And if you're not receiving our reports, please get in touch with me and we'll put you on our mailing list. For those of you that are not subscribed to the CRA, please check out our 30-day free trial where you see our products that we provide. Thank you. That is where I leave it. Thank you very much.
Thank you, Peggy, for carefully unpacking the current state of our economy, as well as the outlook paints a little bit of a gloomy picture, but we do hope that we can make a recovery in the next months or maybe even years to come. All right, over to our next speaker now. She's no stranger to the industry. She goes by the name of Thokozile Mahlangu. She is, of course, the CEO of the IISA. She's going to be giving us an IISA update, and more particularly on the upcoming AIE conference. Over to you, Thokozile.
Good morning, ladies and gentlemen. There are 11 days left to the annual insurance conference, the 2021 African Insurance Exchange. We are excited and looking forward to our first ever virtual conference. An event of this nature takes a lot of collaboration to make sure that we bring comprehensive content and topics that are topical and relevant to the industry. Collaboration enables us to make sure that that comprehensive nature is embedded in a conference of this nature and that we get good and relevant speakers. As we are maneuvering through the digital environment, we thought it fit to have a topic on mega trends in technology. Our partners at Accenture have published a report that looks at mega trends in technology, how it's shaping the way we interact, and how it's going to continue shaping the way we do business. Mr. Vugani Mqadi, the CEO of Accenture in Africa, will facilitate a conversation with 5 of his colleagues that are experts in this field. We will also have a panel discussion on disaster management, one of the issues we've been talking about for a few years with regards to the insurance gap, the protection gap. There'll be a panel that will discuss that and look at how are we to respond as an industry, reinsurers, insurers, and government on how we then design solutions to make sure that the protection gap is no longer a gap. There are ways that we have solutions to plug it. So visit our website for a detailed program that highlights the different panel discussions, the topics, as well as the speakers. As I close, I'd like to thank the sponsors who have always been loyal and support us and believe in what we do. Munich Re, a platinum sponsor, Swiss Re, Sazria, Discovery Insure, Gifts, those are gold sponsors. And we'd also like to thank our silver sponsors, Allianz, as well as Santam and Guidewire. Our general sponsors, GuardRisk and Lloyds. I also want to thank sponsors who have taken the initiative we brought to the industry in 2019, where we invited sponsors to fund Black SME brokers to attend conference at no cost to them. That sponsorship enables us to invest in skills development in the SME broker environment, but also addresses an enterprise development element. Those sponsors are Discovery Insure, Constantia, Old Mutual Insure, Indwe, Bright, Sazria, Lombard, and Santam. Registration is still open, so visit our website to register before we close. Thank you.
Thank you so much for that update, Thokozile. And we are certainly looking forward to the AIE conference coming up. Do make sure that you register yourself if you have not done so. Registrations are closing soon. We have posted the registration link in the chat, so do the right thing. If you have not registered, you might just be one of the lucky winners. We are going to be doing a random draw, and any one of our attendees can win the ticket to the AIE conference. You don't have to do anything. We will be doing a draw, and if you are the lucky winner, we will be in contact with you. So thank you once again, Thokozile. All right, on to our next speaker now. He goes by the name of Elan Ossen, sorry. It's Elan Ossen. He is the head of technology at Discovery Insure, and he's going to be talking to us about telematics and mobility trends. Over to you, Elan.
Everybody, thanks a lot. Let me just share my screen. Just give me a second. Okay, great. Hi, everybody's doing well. My name's Elan Ossen. I head up telematics for Discovery Insure. And I'm just going to talk to you today a bit about sort of the increasing relevance of telematics. It is significantly growing, particularly in the times we find ourselves in. I'm going to talk to some trends, some insights, and also some applications of how we work with telematics here at Discovery Insure in our Vitality Drive program, and I'll keep bringing examples in from there. Before I actually just get into sort of those topics and areas of discussion, I just wanted to give you people an overview of where we stand as a Discovery group and sort of how we've progressed over the years, just to understand the structure of our group here at Discovery. So Discovery was born out of a core purpose to make people healthier and enhance and protect their lives. We have a number of what we call key businesses in the South African market, ranging from our health business through to our new bank that we launched a few years ago. Discovery Insure sits in as one of our key underwriting businesses in the South African market. We then have an adjacent business in the UK, which goes by the name of Vitality itself. That's our health and life and invest business. All of these businesses are the core insurance underwriting businesses, and they're all underpinned by our Vitality program, which is quite key to the overall offering at Discovery. Recently in the UK, we just launched also a short-term car insurance business, Vitality Car, also based on the same Vitality and Vitality Drive concepts that I'll be going through today in the presentation. And then on a global scale, what we tend to do is take the Vitality offering, package it, and partner with insurers globally to offer them the sort of the shared value behavior change model, which I'll speak to in a few slides' time, to their clients. And this business, born out of South Africa, has scaled really nicely across the world, now in 28 countries with more than 20 million customers. So that's just an overview of the group and our structure, and how Vitality is pretty core to the way we operate. Turning to our business model is around what we call a shared value insurance model. The term's probably becoming more prevalent today, and you'll hear it a lot more. But fundamentally, this term was born, out of initial thinking around the early 90s here in South Africa from Discovery. The shared value model talks to the ability to be able to provide incentives and rewards to customers for changing their behavior and doing the right thing. So in the case of driving, for example, you're looking to incentivize drivers to drive well. And if you do that, you create a value or value creation for an insurer in the form of less accidents, less claims, and that value you can give back to the client. And as a whole, society also benefits, particularly again in a car insurance or vehicle insurance example, you would find less accidents on the road. So you get this virtuous cycle, we call it a virtuous cycle of good, where everyone benefits from the business model. And this type of model is what tends to work through all our businesses within Discovery, and the thinking that we do when we look at every single type of business or product we create. Within the Vitality Drive specific program, there are key fundamental sort of layers that make it successful. You'll find in the world telematics, it's been around probably for over, a decade or more. And if you look at a lot of programs globally, unfortunately, some started very early, didn't quite make it, some regained traction. Some started and are still going today in some large insurers, but for whatever reason, aren't gaining the traction that we would expect them to. And a lot of the time, what we find is when you look at a telematics-based program, is it needs to be very holistic, and it needs to include all these layers or all these components in order for it to be successful. Technology is one thing. Technology is the ability to deliver it, and it is fundamental to a telematics program. You obviously cannot do these types of programs without the technology components, but you do need the ability to look at the overall actuarial dynamics from the data layers, the pricing, and then these behavior layers to be able to incentivize the chain. So in the Vitality Drive program, for example, we have behavior layers which look at how you can change behavior and provide unique incentives in terms of different statuses, and I'll speak to how you can reward in the various reward programs, but you sort of need that holistic view in order to deliver at least that's what we're finding, or to deliver more of a successful telematics-based program, as opposed to just, sort of implementing the technologies and thinking that the technologies themselves will affect the change that you're looking for. Okay, so just talking to telematics on a more global basis. So in terms of the actual growth of telematics globally, if you look at some of the studies today, unfortunately, it hasn't, in terms of the predictions of what the number of policies were globally, we haven't really reached that. Some of the predictions were around 2020, 2021, we would be at roughly about 60 million global telematics programs or policies. We're probably sitting now, some of the research is showing between roughly 20 and 30 million. So we haven't quite reached the predictions that were there. However, we are seeing an increase in the growth, and we are seeing an increase in the interest. So you can see here, for example, in Europe, there's been a significant increase in UBI, usage-based insurance, particularly over the last year, as people want to get more sort of usage-based with their car insurance, given the effects of COVID and people's trends in terms of not driving, etc. They really want the insurance to follow suit in how that is priced for. And also what's obviously a big, or has been, but I think is becoming less relevant concern with usage-based insurance is sort of the privacy and data sharing aspect. In a telematics program, you have to share, or you do share a fair amount of information related to how you drive, location, etc. But we are again seeing increases in the number of people who are willing to share their information. Obviously, it depends on the design of the program and what the reward mechanisms are, but fundamentally, there is an increase, and we've got roughly around more than 8 million sort of policyholders in the US who were happy to share their data in 2020. So you can see that there's definitely an increase in the interest. The interest is there because, I mean, I think the benefits are fairly obvious when you look at how the type of technology and what it provides can do. So you get this concept of hyper-personalization, where you're basically able to price on very unique risks because you're actually looking at the individualized driving data. Traditionally, in the normal pricing world, you look at static information to be able to price a risk. Here we look at the specifics on the actual driving profile, and then we're able to price the risk. What also comes into play is this ability to affect change. So if you can measure the driving behavior and you can incentivize, then you can change it. So telematics obviously plays into that sort of world and the ability to be able to provide that. A key thing with telematics is the ability to add value-added services. And one of what we find a major value-added service is around being able to provide more safety and safety features to customers. So the ability, for example, to detect an accident, and I'll speak to that in a bit more detail. In South Africa, more pertinent probably around stolen vehicle recovery, etc. And the ability again for the data to be sort of real time gives you very real time access to the information, and then the ability to interact with the customer. The insurer benefits are also obviously, as I spoke to in the shared value model, obviously quite pertinent with telematics, given that you can price individualized risk and the ability to change that behavior. You get the savings in the claim side and being able to deliver these additional features and look after the clients more. You also, what you find in a telematics program is you then interact with a client on a more positive basis, more frequent, as opposed to just tending to interact just traditionally on a claim. You almost become part of their way of life and helping them to evolve in terms of whatever aspect that particular insurance model is playing into. Speaking more now towards the how the technology trends. So as I mentioned, obviously technology is one component of the puzzle in a telematics program, and obviously, and you need all the other areas to make it successful. But fundamentally, it does need to be there, and in telematics wouldn't be possible without the ability to do these what we call driver monitoring capabilities through these devices. And adoption has largely been driven by the evolution of the devices, and by the evolution of the devices becoming more accessible, becoming more commercially feasible, etc. So I just want to talk to that for a bit, because it is quite important, and you can see some trends evolving how this adoption is happening. So when we look at how we enable telematics from a technology perspective, the traditionals and first ways of doing it in the early days has been with what we call a black box device, which is physically fitted to the vehicle system and to the battery. It gives you, it sort of has independent data connections, machine-to-machine connections to provide you with the driving data. However, it is obviously a logistically complex, and it does have come with a high cost to be able to maneuver and implement these types of devices. Moving sort of along, you get another type of device called the OBD, or onboard diagnostic. A lot of vehicles have a port in the vehicle called an OBD port, which is similar to the shape of what you see here on the screen. And this is pretty much a self-installed device. It's connected to the vehicle battery and also wiring system, because you can actually get other information related to the vehicle from an OBD, depending on how it's built. But obviously you have, and then again, it's got an independent connection and can send the driving data directly without any user interaction. However, obviously, again, the device costs are quite high, and you have the ability for it to be removed or taken out, etc., especially at times of servicing and those periods of the vehicle's lifespan. What's becoming more prevalent is sort of the one on the right, which is what we call smartphone telematics. Smartphone telematics is fairly new. It's probably a couple of years that it's been in play, but you'll see from other slides that adoption is becoming quite large. And the reasons are fairly obvious in terms of accessibility. So a lot of work has gone into being able to build applications to leverage the same sensors that are inside the phones to be able to provide the telematics data. Essentially, you have two types of sensors, which is your accelerometer, which is a device that gives you sort of your G-force readings or your forces acting on the vehicle, and your GPS, which would give you your speed and location. There are other types of sensors, but predominantly those are the main ones that are available. And a phone technically has all of those. So a lot of work has gone into trying to leverage what's there and provide that information through so that accessibility is easy. And the way you would do that is you'd have an app, and you'd have an app that reads those sensors. But a lot of the difficulty with this type of solution is the ability to be able to translate that data correctly. When you've got the other two devices on the left, they're typically secured to the vehicle. So there's less moving around. Obviously, with a phone, it moves around quite a lot. So you need ways to be able to work out how, to get the accuracy of the driving data. And a lot of work has been done by a number of companies around the world with strong data science and technical capabilities to be able to take that data and translate it directionally correct. And that's why this trend is starting to happen. And it's the forces of this concept of cloud and big data and being able to process these large amounts of data to be able to do this. So the evolution of all of those underlying technologies has allowed us to get to this point to start offering smartphone telematics at the scale that's starting to happen. You can configure the phone typically to do two ways to get driving data. One is where it detects automatically that a trip has started. There's algorithms in the device that works out the vehicle is moving in a certain way. And you can configure it in what we call a phone-only mode. The second way is a way that we implement here at Discovery Insure, and I'll speak to it, is using a small IoT sensor. So the reason you'd have an IoT sensor is you would place it on the windscreen, and in there you'd put an accelerometer just so you get an independent accelerometer feed, and there are other benefits which I'll speak to in the next slide. In both of these solutions, because there's a myriad of technology solutions out there, one of the key aspects that you need to have in play is that the user engages with the device, allows you to access certain sort of sensors, the use for the app to access the GPS, etc. And that is a dependency for these type of technologies to work. But the advantages are quite large given the way it can scale and the ability to get the telematics data feed. So just to speaking more to the sensor concept and the phone and why you would typically find the solution out there. The reason this is in play is you try and marry the best of two worlds. One where you had a fully installed device that's attached to the vehicle, versus also having the ability to scale it to the phone. So you have these small IoT units that are very low power and are easy to install. And we place this on the windscreen of the vehicle. As I said, it has an accelerometer in it. The device talks through to the phone. The phone also uses its sensors. The GPS device, for example, would sit in the phone. So you wouldn't really have that sitting in your smaller sensor. But the benefits you gain by just having that independent sensor are large. So for example, you're able to actually sort of marry the risk or the data directly to the vehicle. Whereas if you're in what we call a phone-only mode, you're going to move between different modes of transport, different vehicles. You don't really know where that data is coming from. So you're able to actually get that data linked directly to the vehicle itself. What you could also find is sometimes the phone isn't in the right state to record the information, or the phone's not there. What this device can do is it can at least, from a timing perspective, give you sort of what we call time on road, that the vehicle's being driven, and then we're able to marry that data with the phone data as well at certain points in time. You also can then enable safety features. So we're getting better, I think, at detecting accidents with what we call phone-only devices, but I still don't think it's at the level of accuracy we would like. So when you actually have a sensor secured to the vehicle, you're able to transport a high impact or various types of impacts from the device through the phone and to the back end. So that's another advantage of having the sensors in play. And another key one is actually also around, as I said, matching to the vehicle. But it's not only matching to the vehicle. What you're doing is you're only recording trips in the insured asset. So from a privacy perspective, that comes quite important, because you're only really insuring the asset, as opposed to in a phone-only mode, the phone's moving between different vehicles, etc. So you would be recording all that movement, I guess, really unnecessarily, because that's not the data you're requiring to be able to score someone correctly for your insurance policy. And then also having an independent sensor as opposed to something on the OBD keeps you away from the vehicle wiring systems and all the issues that may result with tapping into those systems, etc., on a vehicle. So this graph gives an idea of the different types of sort of devices that are out there and how the trend is changing over time. So you can see that in the early days of telematics, black box was most prevalent, OBD was in play. And today there is still quite a lot of black box devices, OBD. The OEM is starting to emerge as well, as in that data directly from the vehicle itself, but there are complexities there, which I'm not going to go into in this presentation. And then, of course, the mobile, as you can see, quite rapidly is starting to emerge as a technology of choice for the obvious reasons that I mentioned earlier. Okay, so just looking at how we do telematics, particularly in Vitality Drive, from a technology perspective, we use the phone in the sensor, as I mentioned, for the reasons of why we have the sensor in play in the previous slides. The solution we implemented around 2015. We launched Discovery Insure in 2011. So when we launched, we actually had majority black box devices, and we still have those in play today, but we sort of pivoted into the smartphone world as it was emerging around 2015. And on this system, we've collected large amounts of data, working very well into the program as it stands today. Just to give people a view of how our Vitality Drive program actually works, we provide different aspects of the program which accumulate certain amounts of points on a monthly basis. The higher your points, the more it translates into benefits and rewards. Our top line reward is a 50% cashback in fuels if you spend it at specific partners such as BP and Shell, and you accumulate certain points every month, and whatever your fuel spend is, you get 50% back on that, depending on how much points you've accumulated. Another unique aspect of rewards is our active rewards program. So each week we encourage you to get a certain amount of points in the week, and achieving those points will unlock a smaller goal. So these are all additive rewards. So you get up to the 50% plus the active rewards. And then we have something called status-based rewards, where if you potentially maintain a certain status in the Vitality Drive program, you wouldn't, for example, get an increase on your annual underlying policy. The points are divided into different areas. Predominantly, driving behavior is the most significant, because that's how you can change behavior. So that aspect is there, and there we talk to the general metrics of what we call acceleration, braking, cornering, nighttime driving, and time of day driving, and those we measure from the devices, and that will get you your majority of points. And then we have sections around being able to know the knowledge on the road and doing online assessments. And we also have a partnership with Tiger Wheel and Tire to be able to get points actually checking the vehicle is all the servicing is correct. So trying to get a holistic view. It's not only driving behavior, although driving behavior is definitely sort of the key area in which you can affect the change and provide the incentives. And then, of course, when you do these types of programs, and just to show some of the outcomes, which I spoke to, so the technologies enable the ability to do the metrics and to be able to measure those types of driving data. But essentially, what this translates to is the effect on the actual sort of status and relative accident frequency and severity. And you can see through our data, moving from our lower driving bands of blue through to diamond, you get a significant improvement in accident severity and frequency when you look at the different status. You can see the trend in the telematics talks directly to the risk as well, and the underlying risk, which is very different from your traditional pricing, which would price every more statically. This allows you to manipulate that over time. Just talking more to safety features, which is a unique benefit of telematics, and that is the benefit of being able to do a number of things. The key one is being able to detect accidents through the device. But there are other things you can do, like being able to enable panic buttons through the system, because it's essentially a tracking type system or policy. You can have parents have the ability to track their children or other people on their policy to be able to see that they're safe, and you can build a whole myriad of safety features around that. And then predominantly in South Africa, you would have things around stolen vehicle recovery. So that is a key safety feature that plays into this as well. If you look at sort of our vitality drive over time, as I said, we've been going. So this year is actually Discovery Insure's 10th birthday. Sorry. So we have collected a significant amount of data, but what's pertinent is we're starting to find trends now around fatality rates. So, for example, in the Discovery base, we find that we're sitting on about 13 per 100,000. Fatality rates, fatality rates, but in globally in South Africa, it's sitting at around 22 per 100,000. So you can see the society impact as well from the data, as well as the overall other benefits that I explained before around the pricing. We've paid about over 1 billion in fuel cashbacks and various other rewards. The active rewards program, these smaller rewards, has been hugely successful. With 10 million active rewards being achieved, and the idea of these people who adopt quite early the active rewards actually increase their scores quite quickly, and you find them in the more top cohort of better driving behavior. So I just wanted to talk more to some of these safety features, and then also what's evolving larger with telematics in terms of being able to help the larger insurer in the operational side, particularly around claims processing, etc. So as I mentioned, the ability to detect an accident is unique with telematics. It's not a simple thing to do. There's a lot of what we call machine learning techniques, classifiers that sit on the back end to be able to detect what is an actual accident, trying to take out what's false versus real. And within our environment, we have quite a few data scientists constantly evolving these solutions because they're not really static, and we're sort of learning something new almost every day. So we have classifiers that run, an accident is detected on the little device, goes through the phone, and when it's picked up, we have a workflow system sitting through our emergency 24 call center, which picks up the alert. And once it's got the alert, we're able to track the device to see if it's moving, not moving. And if we can or can't get hold of the client, we can make certain calls on whether to dispatch emergency services. What's also unique from a telematics perspective, being able to evolve more, it's more around the data science around what's emerging from the devices, is being able to determine the exact sort of reconstruction of what happened at the time of the accident. So typically, we've started working on elements of trying to determine an automatic crash description from the telematics data, So for example, you can see here in this example, of course, typically the way a claim's logged, they phone in, the description's done between the agent and the client on the phone, and they would write up a certain description. And the bottom part is you can see an AI or machine learning description. So again, trying to keep it human focusing, because you want to be able to read it as a human being and understand what happened, but try and make the detail quite specific. And this is what the machine learning and AI is trying to do, to be which it got directly sort of from the core telematics data. And you can see, if you were to analyze it a bit more frequently, basically you can see that the descriptions that the call center put in is what's being picked up by the system. We then try to give visuals around hit location. So so they say they were bumped, so a hit from the back. There's a G-force curve in the middle which shows where that's happening, and then to try to give a severity around that that hit. And then there's a lot more in terms of being able to run the processing through. What this does is it speeds up potentially your claims processing. Being able to do this, you can quickly determine what happened, and then you can help the client much sooner. You can send them to the relevant, instead of having sort of your assessor come in and assess, you can then send them for the relevant panel beating, etc., quite quickly. So I just want to move a bit. I'm just moving a bit quicker. Yeah. Another area where telematics helps in your whole approach to product as well is being able to react quickly to changing trends. And obviously, COVID is unique. I mean, most insurers know that people started driving less, but you can see it here in the data when you have a telematics device. These are different lockdown levels and the distribution of our client bases in terms of their how much driving they did over the different lockdown levels. So you can see, as soon as we hit the higher lockdown levels, there was less driving. And what this allowed us to do was create product to help clients. So because we could work out exactly which clients were driving and how much they were driving, over and above the normal sort of vitality rewards, we gave additional premium sort of savings back to clients, up to 25% for driving less in the month. So, and we've paid over 250 million rand in that currently. So just the way that telematics plays into, because you don't know how things are going to play out, but having that data and being able to react is quite unique. Another big area where telematics is starting to become prevalent. So obviously fleet management systems and being able to monitor large fleets has been around for a while. But I think the combination of adding again the other parts of the value chain, the incentives, the rewards, is quite significant. And we moved Vitality Drive into a commercial space just over 2 years ago. But you can see, and we've also now started to move into heavy commercial vehicles, because you can see a lot of the trends, particularly on the right-hand side, around what causes fatality, are again around, driving behavior, fatigue, aggressiveness, distraction, etc. And if you can measure those and change those, you can make quite a significant fleet, which plays large on our roads. And a big statistic here is that 71% of commercial vehicles accidents were as a result of distraction. And again, if we can measure that, which we can do through the devices and various other mechanisms, and incentivize not to be distracted, you create quite a significant change to driver behavior in a fleet environment. And within the Vitality world, we offer sort of products around, giving the ability to give percentage discount to the overall fleet that's run well, up to 30% of your premiums back. And then we also individually incentivize the driver, because they're the key that's going to build up to that 30% saving, with smaller rewards each month through the active rewards program, and give some form of fleet management monitoring to your fleet. But what we're starting to see now is there's a larger evolution in telematics, which is moving towards what we call video telematics. And this we think is going to be quite significant. You've probably seen some of these aspects in more of what's starting to evolve in more the self-driving world, but there are elements that you can use in terms of advanced driver assistance systems, which it can be add-on systems to be able to better the risk. And we recently launched a video product in our heavy commercial vehicle space, which is a device that goes in the vehicle where it gives real-time outside and inside cabin views. Every time there's an event, a driving event, acceleration, braking, cornering, or an impact, etc., we would get that information through to the system for the fleet manager to be able to react to, and then you can provide trips and information directly from the device to the driver. So sort of the evolving world of advanced sort of video telematics is coming into play, and there's a lot more you can start doing with these types of devices, giving the artificial intelligence, what we call edge processing power, to be able to give real-time feedback to drivers in terms of what's coming up, etc. And there's a lot of R&D that's happening in this space. And again, playing out in our commercial model is a very similar trend in terms of relative loss ratios, claim severities across the fleets and across the drivers in terms of the higher status bands through to the lower statuses in our blue. So you can see the same evolution or dynamics play out in the Vitality Drive program in the space. I just wanted to end off with one last aspect, and this is the ability to take telematics and help it. You can push it more broadly from a societal perspective, and this is just one example because it is quite recent, and just wanted to explain it to everybody. So recently, in partnership with Dial Direct and Discovery Insure, we sponsored the pothole patrol to be able to go fix potholes in the city of Johannesburg. And part of the process of what we're doing here is, while there are ways that the potholes are reported, they're reported the moment, I think, on an email system. There's going to be an app where you can send it in. But apart from this, is we're also trying to use telematics to be able to direct the vehicles accordingly. We can detect different types of vehicle impacts. We can look at the signatures that come through in the low-level driving data, and the data science teams work quite closely with the teams at the pothole patrol to be able to feed that information through and keep learning around the roads. And the more we can train these models to be able to do this, the more reactive you can get to be able to fix these issues and help at a larger, broader societal level. So yeah, that's what I have for you today. Let me just, I think I don't know how we're doing for time, but I'm not sure there's any questions. Okay, there are some questions that have come through. I'll try to answer just in the interest of time. Sorry, I'm just going through them quickly. So yeah, okay, so there's a Poppy question, yes, quite relevant around telematics. Yeah, so the way our programs work is they're fully opt-in programs, and the way Vitality Drive is actually designed, it's a rewards program. So you opt in for the rewards, and you're able to and then it's fully sort of Poppy compliant from that process, and then all our sort of processes within Discovery fully protected in terms of how the data is moved around the organization. We've seen our telematics is brought. Okay, there's a question around like sort of next market revolution of telematics. I think it's vast. I think the number of IoT sensors that are starting to be connected is significant. There's more to do just within more than motor insurance. I think there's a lot of stuff happening in terms of home insurance and the ability to be able to monitor in the homes, etc. So I think that trend is coming in quite significantly, and there's a lot happening there. Okay, I'm going to leave it there. I think we out of time, but thank you everybody, and hope it was relevant for you.
Thank you so much for that, Elin. Really interesting to see how telematics has advanced and evolved the insurance industry to what it is today and how it will continue to evolve in the years to come. So huge thank you for that presentation. A reminder once again that Elin is from Discovery Insure, our headline sponsor today. Huge thank you to Discovery. On to our next speaker now, also from Discovery Insure. She goes by the name of Nonkululeko Paki. She is the head of Employee Health Solutions and Group Strategic Client Solutions at Discovery, and is going to be talking to us today about corporate trends and well-being during these difficult times. Without any further ado, it is over to you, Nonkululeko.
Thank you so very much. Hello, everyone. I hope you're all well and safe. I think we've all had a time in the last while, and it's just really wonderful to be able to be here in a platform like this. Really what I've been asked to talk about is really how we think about well-being and wellness within the Discovery context. And I think the best way to almost share this with you is probably to speak to you about what we've seen with our own employees and what we've done in terms of addressing corporate well-being. I thought maybe there were two sort of key agenda items that we could cover during this period. The first one being just our changing world. A lot of the speakers would probably have spoken about the trends, so none of these will be new. But I think critical perhaps and useful to speak about them in the health context, and that will give a segue into the well-being space. Then, as I said, secondly, sort of taking the Discovery lens in terms of employee well-being. There are four key trends that I'll be touching on today. So the first one is around innovation and change adoption, particularly within the health and well-being space, the healthcare reforms that we're starting to see, workplace evolution, and then we'll end off with how this all comes together in terms of employee well-being. So in the last while, and you've probably also seen it, but there has been a rampant innovation. And what we've seen is really where the innovation has been most successful is where you've put the customer in the center. So not only have you brought innovation, but you've put the customer in the center and are dealing with key issues that they are facing right now. In addition to that, what we've also seen is that the change adoption has been exponential. It's been faster than any kind of sort of change and buy-in curve that we've seen over a long period of time. Some key changes that we've seen in this health and well-being space, all of you will probably be familiar because you're probably using it in your own context. But the one component has been virtual consults. We've used this both sort of for primary health care, so for seeing your GPs. This has put the customer in the center because it keeps you safe. You don't have to go into your GP's rooms, but very important at this time of COVID to be plugged in and to know that you're being supported. The picture that I've chosen there is to show you we've also used it in the well-being space, particularly for psychologists or social worker visits that can be done virtually. The claims process is seamless, and how we integrate with the health professional as well as the client is really meaningful. The COVID Alert app, I think, has been a magnificent sort of innovation that's come to bear, which was a partnership between government and Discovery, but really, again, putting the customer in the middle. How do we help protect the entire nation by putting something out that is digital, that is meaningful, that alerts you when you've been exposed to COVID-19? Some of you might have been exposed to hospitals at home, but the innovation in this space also incredible in terms of health and well-being. So the customer is in the center in the sense that one, they're at home, but two, that you use all the digital capability, and you also have to use soft touch to look after the customer from their own home. This has actually had to be used during COVID with the overflowing hospitalization utilization within our space. So some people who could not be admitted, we brought solutions such as hospital at home, where we could use telematics to be able to, sorry, not telematics, I was listening to my colleague, telemedicine, to be able to evaluate and to be able to keep close to people and monitor them from a distance. And then finally, something that actually really appealed to me, and I'm not sure you found it the same, but was really how NextPath was almost a lab that responded meaningfully to the health and wellness needs of people during this time. So one, taking you out of the normal construct of having to go into a building, physically having to leave your car and go in order to give you to do your COVID test. They put the customer in the middle in the sense that they said, how do we minimize exposure at all costs? We'll keep you in your car and we'll come to you, which was brilliant. They showed up in places that were no longer used, such as basements, in malls or in shopping centers that had low capacity and therefore were not used. But also they used technology for you to be able to pre-book, for you to pre-populate. When you get there, it's quick and efficient, and your results come very quickly and again, deployed to you through your phone. So really, I think across the spectrum, we've seen rampant innovation, and the innovation has been quite powerful where it's spoken to the customer, and that made the change adoption really quite simple, and people really have moved in terms of innovation and health reforms. And I don't know, but what we believe very strongly is some of these trends will not be reversed. So virtual consults, hospitals at home, finding new ways to deliver healthcare, such as the drive-through capabilities, will probably continue into the future. Then another trend that we've also been steeped in has been the workplace evolution. And I think this has been the same for all organizations around the country, multiple forums, executive forums, board levels. And it brings both, I think, great opportunity, but to a large extent, I think it also brings some anxiety. And when we've looked at all of the research, what I think has been central to this is that there are three components that we have to be focused on. The first one is the human component, and you've got to put the employee in the middle. And the human component talks to the fact that the employee chose an organization because they were interested in that culture and in the values, and you need to be able to keep those alive. That people are motivated by environments that are optimistic and uplifting. So how do you make sure that that human connection and that social connection continues? The use of digital to be able to be an enabler for you to work anywhere, anytime. We literally, within the discovery context, had to move about 8,000 people home with the first wave that occurred. And we had to move people home, but quickly set them up because we are vital to the healthcare system, especially within the discovery health space. So how do we set them up and continue to support members who need us at this crucial time? So the digital capability, the ability to also have continuity. We've had to think about things like, do we provide people with UPS, some backup power when we have rolling blackouts so that there's continuity of service for our clients? So really broad topics that really require in-depth thinking, because not only are they pivotal, but they're also quite costly. Then the physical component remains quite important. And for us, the physical component obviously manifests through our buildings. We've built incredible buildings and spaces for our people to work. They've been set up and constructed in such a way to foster collaboration and engagement. And so how do we make sure that people still see these as places to anchor, to come collaborate and to use? And as I was just, we've been looking at this for quite a long time. In fact, in the past week, in one of our executive committee forums, we're discussing it in more detail. But I was looking in terms of just past sort of the next 2 to 5 years, what this would look like. And I found this most incredible video. And I thought I should share it just to almost cast your mind into the future of how we think about our employees, how they're going to have to interact with our environments, but also about their well-being, which is core to how we build these processes and these environments. So maybe if we can watch this together, I just need to make sure that you're able to hear the sound. Please excuse me for 1 second. I'm going to unshare, and when I share again, I'll share sound.
Good morning, Amy. Where would you like to work today?
The office. What's the weather like today?
The temperature is 18 degrees with a 57% chance of rain. Are you ready to start your day?
Give me 10 minutes.
Okay. How would you like to get there?
I'll walk.
Do you want to ride?
No, I'm good.
Thank you. Careful, Amy. Obstacle ahead. Nearly there. Good time, Amy.
Good morning, Amy. Welcome to JLL. You have one message from William Douglas.
Okay, thanks.
Thank you. Your first meeting is at 10:30. Please proceed to the elevators. Have a good day.
And you.
Lisa is in today. Lunch?
Good for me.
Invite sent. Have you seen the latest report?
No.
Your coffee will be ready in 5, 4, 3, 2, 1.
Thank you.
Tip sent. This building uses sensors to make your day more productive. Need a desk?
Maybe later.
Sure. How's the temperature?
It's fine.
Ready to start your meeting with Eloise Dupont?
I am indeed.
I'll let her know.
Bonjour Amy, ça va?
Bonjour Eloise. Hold on.
Auto-translating.
Vous avez vérifié le document que je vous ai envoyé?
Yeah, all looks great. Thanks very much. Au revoir.
Bonne journée, au revoir, merci.
Are you happy to share your building usage data today? Have a great evening, Amy.
Plan for route home?
Stop navigation.
Navigation off.
Send a message to Tom. Are we still okay for the meeting tomorrow morning at 9 o'clock?
Message sent. Would you like to switch to personal mode?
Yes, please.
Personal mode. Work mode returns 7 a.m. tomorrow.
Confirm.
Have a nice evening, Amy. Enjoy the sunset.
Good night, Jill.
I hope that gives you a sense of the whole element of about putting the human in the middle, but using digital in a powerful way as an enabler, and then using the physical environment in order for you to be able to maximize the employee well-being journey and the employee interaction within that space. So with that being said, so those were just some of the initial thoughts in terms of what's happening in the world and what we can do about it and how can we learn from it. And so maybe to take you a little bit into the discovery world, some of the learnings we've had, both locally and globally, and what we're then doing. And I thought the best way to bring this alive will probably be through a case study. So firstly, the why do we do this? This actually happens to be our core purpose. So within the discovery space, really, the drive is to make people healthier, enhance and protect their lives. And we don't think that there's a more important purpose right now just around making people healthier, enhancing and protecting their lives, given what we're going through. What we've also known, and this we've known even pre-COVID, is that the global state of mental health has been concerning for a while and has been accelerating in terms of the requirement for support within the space. 1 in every 5 adults suffer from some kind of mental well-being or mental illness on a spectrum. In addition to that, what we also see is that there are correlations between people who suffer from mental well-being being at risk for other conditions or other problems. So as an example, people with mental illness have 2.6 more possibility in order to adopt a healthy lifestyle. There's also a more increased prevalence of chronic risk that could also be almost, I guess, in a word, prevented should we take the relevant steps. I did some research that really looked at how people were responding pre-COVID and then during COVID, and what was the increase in terms of depression and anxiety. Unfortunately, the research didn't include South Africa, but I think we are basically an extrapolation of what's happening globally. What you can see is not only concerning, but it's truly frightening in terms of how people are responding to what has been a global trauma in essence. On the left-hand side, what you'll see is that the prevalence of depression has increased significantly. In some places, you'll see that it's been double. In other places, almost by 300%. The same has happened in terms of anxiety. What's been quite interesting to note is that the increases are also, if you look at the timeline, are correlated to times when there's been periods of, I guess, more deaths or more intensified action by either a government or by society in terms of the prevention of COVID-19. We then did some research and using our own data. And in terms of this research, really what we wanted to see is, was there any correlation between the use of our wellness solutions relative to what people were going through within the country? And this is very interesting, actually. What you'll see on the left-hand side is what the well-being searches, related searches were during the time when lockdown started in South Africa last year and we entered the state of disaster. These were the three biggest searches. So the first search globally, the biggest one was around the COM app. And you can see that during this time where everybody was going through some kind of lockdown, you can see how that increased. Within the South African space, it was yoga. And you can see the sharp increase as we went into our first lockdown. This very much speaks to the fact that people were already trying to lean on and leverage some kind of health and well-being solutions or programs out there. What was equally concerning is that within South Africa, the second most searched outcome was actually around deaths. So people were also obviously concerned around what this would mean, what this pandemic would mean, and what would it result in. And so you can see there. If you look on the right-hand side, this reflects our data, which is Healthy Company data, which is our health and well-being program. And you can see that as these peaks were happening, at the same time, we saw exponential volumes coming into the Healthy Company space where people were seeking support. So organizations that we cover and that we look after in this component were seeking support. And you can see how it starts to climb with the first COVID case, how it hits sort of a peak during the national state of disaster. And once people sort of start to get used to it, you can see how it starts to climb down. So really a correlation between intensified need for corporate wellness to play a role during these pandemic periods. What we've then also extrapolated is really looking at our data around why people were contacting us and where people are struggling the most in terms of well-being. And what you'll see is that 7 out of 10 of all of our interactions within the Healthy Company space, which is our well-being program, were really focused in that emotional and mental well-being arena, while 1 out of 10 started to hit the financial well-being arena. If you look at the reasons why, and I guess it goes without saying that these are intuitive and make sense, but you'll see things like partner, spouse, divorce, separation, really the compression that the lockdowns were creating, that families were thrown in together and had to cope in a particularly rough period. And you can see it come out here. Grief and loss as people started to lose people. You can see the family stress, chronic depression, work-life balance was a big one. And then the issues around child and family care started to crop up as children were also asked to stay home as opposed to coming to school. So I think none of this is a surprise, but interesting that the data basically validates the things that are going on within our society. How we've then thought about this, and just to give you a sense, this thinking is now being intensified and is now being broadened given what we've learned over the last while. But this will give you a sense of how we've thought about employee well-being. Firstly, we think well-being is across multiple pillars and not just one pillar. That physical well-being is critical because that's where things will usually pop up. So your chronic risk will happen within that physical pillar space. When you're going through a lot of stress and anxiety, you might neglect your physical well-being. Emotional well-being will usually be driven by either financial risk or financial well-being issues or physical well-being or legal issues. And then financial well-being on its own presents new issues like we've never seen before with what the economy has become and how many jobs we've shared. So we really think about this as pillars that require support and attention, but that nothing happens within necessarily one pillar, but people experience these things across the board. The kind of pillars we now actively investigating and that we're doing some experiments within the organization are things like the social pillar. That social construct has become so important where people feel isolated and alone and are living sort of individually during lockdown periods. So that's a pillar that we'll probably be adding here. What we do here is that we underpin this with screening. You will not everybody will put up their hand and say, I need support. But if you have screening that seeks to ask people where they sit, and you can risk classify people based on what you get from the screening, it's really powerful because then you can proactively reach out to the people. So really underpinning our wellness solution is a screening platform that is built into an app that's on the website that can also have a physical manifestation through a wellness day. And out of that, we get risk classification per person on the pillar. So in physical well-being, as an example, you could be green. In emotional well-being, you could be red. And in financial well-being, you could also be red. Where you are high risk, we will ensure that we intervene proactively with you. And then critically is that we'll provide these insights directly to the employer, because the employer needs to know at a macro level what's happening with their employees. I want to put it into the case study and sort of put it into action for you so that you understand how it comes alive. But maybe before I do that, I can just mention an important component of this is that we've leveraged e-commerce and digital in order to support these journeys. So we've got things like personal dashboards for everyone, educational libraries on all of these pillars. We've got risk assessments that are inbuilt so that every time you do a risk assessment, there's new risk classification and we understand when we need to intervene and support people. We've got AI mood capture tools where when your mood is stressed all the time, the algorithms behind this tool will alert us and will allow us to reach out. And then finally, we want to weave into people's lives and live the way they live. So we've built in a tool that basically works as a WhatsApp where you can speak directly to a professional in this regard. We've done this in an app. We recognize not everybody can use an app or has an app. And therefore, we've also done this on web. So we've duplicated it. How it comes alive is like this. So let me take you through a journey. And this is a real journey of one of the people that we've taken through this journey. But obviously, because we want to make sure that for confidentiality reasons, we've changed the names and we've changed some of the information. But meet Thandi. Thandi is 37 years old. She's a female. She's married with 2 children, 8, 7, and 5. Thandi is a learning and development manager. She works at One Discovery Place in Johannesburg. Thandi is currently married has been married for 12 years, but has hit rough times during this COVID period with her husband. And in fact, her husband has filed for divorce. You can imagine the state Thandi is in. So just to give you a sense of how this would come alive. So we would usually have wellness days within the employer space. It's an opportunity for the employer to have physical manifestation of wellness in their space, would have people who are there, nurses and bios who'd be able to engage with people on their well-being, have people do their assessments in order for us to get vital data, but do it in an energized way, so to speak. So Thandi attends this wellness day. Coming out of this wellness day and having done the assessment, Thandi is risk classified as high risk within the emotional and physical pillar. Financial pillar. Thandi then gets a call from a healthy company coach. Again, critical that we use this information for risk classification. And once we've risk classified, we provide the support proactively because people won't always reach out. So we've hired coaches that form the center of our well-being program. And these coaches are psychologists, they're trauma counselor, they're counseling social workers, but the key is that they become your navigator of care. So the coach picks up the phone and phones Thandi and says, Thandi, can I speak to you? I've got some input coming out of your last wellness day, and can I give you some information on it? Thandi, as many of us do, explains to the coach that I actually work in an open plan environment, and unfortunately, I'm not able to have this discussion as I'm concerned that I'll be overheard. Having thought about this and built it in as part of the feature, the coach then says, completely understand, can we move this to the chat functionality and we can continue the discussion further? Thandi agrees. What then happens is that the coach, and you can see we've simulated that, but the coach says, good day, Thandi, how can I help you today? And I'm Trudy. And then Thandi can then speak to Trudy. Hi, Trudy, and then continues accordingly. This can happen on the app, as I said, this can happen on the web. Again, very important. This is taking the human and weaving in the digital tools to be able to support them meaningfully. Thandi then speaks to the coach and really starts to share that I'm going through a divorce, feeling quite anxious, not sure what to do about this. I've got 2 kids and I'm worried about multiple things. The coach as the navigator of care, again, is how do you take the coach, the digital tools, and the human being, and how do you support them? Says, Thandi, we've got lots of support elements for you, but I'm going to help you and point you to the right elements within each pillar that you need. So in the legal pillar, we've got all of these things for you, Thandi, from we can draft contracts for you, domestic employment agreements. But right now, what I think you need is that you need to speak to someone about a residential lease because you're talking about moving out. So somebody can help you draft that. You need to understand the contract that you married under. So that's an anti-nuptial contract. And therefore, what I recommend and what I'm going to do for you is make sure that you have a 30-minute face-to-face consult with an attorney to start this journey. In addition to that, the coach, who's a counselor, also understands that Thandi is experiencing a huge amount of emotional distress. And because they are your navigator of care, they say, Thandi, you need to be able to manage this part of your life. It's a critical part of your life for your well-being. And therefore, I'm going to arrange 5 sessions for you that are available in order for you to do face-to-face counseling. The counselor also then points, Thandi, to the fact that this is all that the employer is making available for you through Healthy Company. So there's 24-hour telephonic support if you need us. You can get a trauma counselor if at any point you need it. There are various articles that I want to point you to that are in your app that you should be reading that will help you with your anxiety and your stress, and some checklists, etc. So again, using the tools that are available through digital and other ways, as well as some face-to-face to bring it all together for the employee. Then finally, the coach says, Thandi, I know we haven't talked about this, but physical well-being will be impacted during this time. And then the coach points meaningfully to, again, in the ecosystem that your employer has done for you, there are many things that you could look at. So I'm advising you to look at some library and to look at the library and look at some of the articles around how to manage your physical well-being during times of emotional distress. And so again, all of this is available at Thandi's fingertips. So again, taking the human, the digital, the support through an expert within wellness and making sure you can support the person appropriately. Then finally, Thandi also came out red in terms of financial well-being, you'll remember. So Thandi says, I'm very concerned. I'm going from a dual household income to a single household income, and I'm not sure how I'm going to cope. And what we've really done in terms of this aspect is that we've built from courses to the ability to speak to a financial advisor, but very critical here is that Thandi can be pointed to all things related to financial well-being that they might need. And they're able to get them at their fingertips. So you can either listen to podcasts or you can watch videos, or in the catalog, you can choose exactly what you need. So you'll see in the catalog there of all the things that Thandi can learn about is number 6, divorce as it impacts your finances and how to go through it and how to plan for it. So a meaningful ecosystem that really can take someone through the journey, whatever journey they're going through. The coach then checks on Thandi a few weeks later. She's doing much better. She at least has an emotional, physical, financial well-being in check. And then she mentions the fact that I have kids and I'm worried about how this is affecting them. The counselor explains that the support that is provided by Healthy Companies, not just for Thandi, but her entire family, including her domestic and her husband, if she needed that to be done. And that's a critical aspect of well-being. People are not islands. You've got to look at well-being at a holistic level and all of the dynamics that are around the human being that works for you. Because if the children are not taken care of in this particular case, Thandi will still struggle and will not be able to be successful in the workplace and be as productive. So the outcome of that in simple terms is that the coach then says, I'm going to do an appointment for the children and they'll be looked after accordingly. So maybe to close off on that, really the key themes here is that you need to think holistically about employee well-being. You need to think about journeys. You need to think about all the tools that you have. You need to think about how those tools come alive at relevant points and what you need to do to help people navigate, access, optimize those tools. In the ecosystem I demonstrated to you is that we used assessments to get an understanding of what's happening with the employees at the center of this ecosystem. Once we understood who was at risk, we used a navigator of care to bring all the tools, whether it was digital tools, whether it was linking you to a psychologist, and help the person navigate that journey. And then finally, we made sure we looked after the entire family as opposed to just the individual. On the company side and employer side, and this is critical, there's no point of doing a whole lot of things for employees, but never giving the employer the power to understand what is happening with my employees, and then the tools to say, how do I further help them and where do I concentrate my investment in terms of corporate well-being? So really a key part of what we've built and what we've been doing is that we have reporting that's integrated, that helps the employer understand the key risk at a macro level of all employees. Secondly, what we've done is that we've built tools that then allow the employer to go in and say, right now I'm driving vaccination. So in the tools, you'll have a vaccination toolkit that says, how do I drive people to take their vaccines? How do I incentivize them to take their vaccines? What myths exist and what data can I provide? And all of those tools are provided in an easy way. There are SMS templates, there are videos there, and the employer can use them as and when they need them, unique to their particular environment. And then finally, there's a need to focus on continuous improvement. And so we continue to have libraries, whether it's webinars or workshops or self-guided LMS tools for individuals, libraries that continue to support people. And that's critical because we think the topics change. So 18 months ago, gender-based violence reared its head in a big way. And we played a big role there in terms of bringing together workshops, thought leaders, initiatives around how companies can think about it. But importantly, where a person is going through it, how do we use the same healthy company wellness journey to support them the same way we supported Thandi, as I've shown you earlier. And that's it from me. I hope it's given you a good understanding of what we're doing in this space in terms of really how we're supporting people from a corporate wellness perspective and how we're thinking about corporate wellness end to end. There are a significant number of questions in the chat. I don't know if we've got any time. I think that I might have overstayed my welcome, but I'll check if there's one or two things I can answer. There's a question here about just how the AI is used in order to generate the outcomes that we have. And maybe given that I only have 2 minutes, I'll answer this one. So, you know, we're very blessed, I think, from a Discovery Health perspective, because there's been a lot of health data that we've been able to leverage and a lot of learnings over time that we've been able to leverage, that we've been able to use in the corporate wellness offering, both for our employees, but I mean, Healthy Companies available for other employers that we've been able to use. So to give you one example of how powerful this is, especially if you have health data and you can take that health data and you can use the health data together with the corporate wellness data. One example is that in the health data, so if you have scheme data, you can see absenteeism as is driven by the claim. So what that means is that if somebody, as an example, goes in to remove the appendix, we will see that within the health data, and we can almost tell the employer that the amount of time absenteeism that is due to a certain type of claim or certain type of medical experience is linked to this. We can also tell the employer, we can see the chronic prevalence within the employer space, and we can come back to the employer and say, the component that you should look at, or the risk that you should look at, is diabetes, because we can see that within the claims data, the number of people claiming for that chronic is quite high. And so your corporate wellness initiatives can then be driven and be directed based on data and smarts in terms of analytics. I also showed you the smiley faces and the sad faces. So we use that as an engagement thing. When the person comes in, the screen is quite simple, but at the top, you've got the smiley faces with a bit of a description: happy, excited, or sad, depressed, unhappy. What we do in the back end using artificial intelligence basically is we look at what the trend analysis is. And when we see a certain trend, we then can pick up distress. And when we pick up distress, we feed that information through to the healthy company coaches, who will then reach out to the employees accordingly and support them. So the employee sees, oh my God, magic. How do they know when they must support me and how they must support me? But this is really the powerful use of AI in order to do things in the environment. I think I'm completely out of time. I hope that has been useful, and I'm going to hand back over to the MC.
Thank you so much for that, Nonkululeko. Your presentation comes at a critical time. There's never been a more important time to have these conversations about overall employee health and wellness. The work you are doing at Discovery truly is commendable. So thank you once again for that. Reminder once again to all of our attendees that InsureTalk15 is taking place on the 26th of August. We have shared the link in the chat. So do the right thing and register today. It is free as always. You can head on over and register over there. All right, we're now going to head on over to our entertainment segment by Bottomless Coffee Band. It is fitting in today's weather, and no, we did not plan it. And that will be followed by a short 5-minute comfort break, after which we will return. But before we do, we have a special announcement to make. Tomorrow, the 23rd of July, it is Llewellyn du Plessis' birthday. You've all come to know Llewellyn. Him and the CN&CO events team do amazing work. They put together these phenomenal events. He's basically the face of CN&CO events. So we want to take this chance and opportunity to wish him a happy birthday. We wish him all the best, and we wish that he will continue to succeed and thrive. We hope that you will enjoy your birthday tomorrow, Llewellyn. All right, so without wasting any further time, let us head on over to the entertainment segment by the Bottomless Coffee Band, which will be followed by a short 5-minute comfort break, after which we will reconvene. Do make your way back.
Ladies and gentlemen, it is Lawrence and Esther Robbie here from the Bottomless Coffee Band, reporting all the way from Paarl in the Western Cape. We are very honored to be on the InsureTalk show. We're going to kick off the show with a song called Folsom Prison Blues. 1, 2, you know what to do. It's rolling around the bend, and I ain't seen the sunshine since I don't know when. Oh, I'm stuck in Folsom Prison, that time keeps dragging on, yeah. When I hear the whistle blowing all down the St. Anne. When I was just a baby, my mama told me, son, always be a good boy, don't ever play with guns, but I shot a man in Reno just to watch him die. When I hear the whistle blowing, I hit my head and I
cigars, oh I know I had it coming. Well, I know I can't be free. But those people keep on moving, and that's what tortures me.
So we are very, very honoured to actually be involved in conservation through our music. We partnered with the CCFA, the Community Conservation Fund for Africa, and we wrote this next song inspired by a poem, and it's really about the synergy between wilderness and man. So for every time this song gets listened on YouTube or on the streaming services, money gets donated directly to protect our wilderness and our communities. So this song is called Wilderness, and it's really a celebration of life.
Told me when I was young that a man and be soul of the fire of the hunger line feels every day to desire. For the giver of life, for the reason of we are born from the same elements. We are the voice of the wilderness. Born from this wilderness. We are born from this wilderness.
We're more than this.
We are more than this.
Okay, so Lawrence, we want to know, what are you doing with
Ooh.
your feet?
This is called the Firma foot drum, and we imported this drum kit all the way from the States. It works as follows: there's 9 pedals that I play with my feet. So my right foot has the bass drum pedal, and then my right heel has a snare drum which sits in the middle, and then my left foot has a hi-hat cymbal. So if I add these together, it kind of sounds like this. So it's basically a full drum kit with my feet. I have another snare drum on my left foot, so I can do a little drum roll. I have a shaker here. And then the grand finale sits on these outer posts, so I have a little cute tambourine and then little clocks, I suppose.
Sounds like little claps.
Yeah, little baby claps. And then the grand finale is this very cute Christmas bell that I have on my left heel.
It is Christmas in July.
Christmas is on its way. So if I add everything together, it sounds like this. InsureTalk, it was a huge honor for us to be with you guys. We want to end off the song with a song that is very special to us and very dear. When we started out as musicians, we didn't plan on actually being musicians. We both went into the corporate sector. I was actually in finance. So we met one another as students at the University of Stellenbosch. And what we'd do back then is we would take songs that we both love, and then we would mash them together and get a certain genre or a vibe going. And this was a song from my background, which was rock and roll, and Essie's background, which is a bit more classically ordained.
And we believe in always celebrating your roots, because our roots is where we come from, and it's good to always remember that. So please look after yourselves, go well, support one another in this time, love where you can, and yes,
That's it.
we are the Bottomless Coffee Band, and this is Requiem.
Thank you so much, InsureTalk.
Thank you so much, Bottomless Coffee Band. That was different, but definitely had me dancing. So I'm definitely feeling a little bit warm. I hope you all enjoyed it as well, and that you utilized your comfort break, got your coffee, and are comfortable again. We're almost at the end of the session. I'm going to introduce our next speaker now. He's no stranger here. He goes by the name of Tony van Niekerk. He is the editor-in-chief at Cover Magazine. He's going to be giving us an industry and media update. Over to you, Tony.
Thank you very much for that introduction. We are skipping today the media update, and what we've decided to do is replace it with a little bit of a chat around technology, and specifically just about the adoption of technology. So I'm talking to Tavio Roxo, the CEO and co-founder of Owls Software. Tavio, thank you very much for joining me today, and I hope that you're ready for the hot seat at InsureTalk.
Thank you, Tony. There's nothing hot about today, though.
I suppose you're in Joburg, so it is a bit cold there. The sun at least is out in Cape Town. Tavio, I know we're short on time, so I'm going to jump right into it. What I would like to talk about today is the whole thing about whether the user can keep up with technology. I mean, first of all, thank you very much for making yourself available and taking the risk of being open for questions. I know you're a real tech guy, and for myself, I mean, I love technology, and I do see myself as an early adopter, even though my kids call me a boomer. Which I probably am, but I always feel that I don't know enough yet of a specific technology, and then the next one is out, and then I'm forever trying to catch up. So I can just imagine people that simply sees technology as functional. How do they keep up? So here's the question: can the user keep up?
Tony, that's a good question. In the world of consumer electronics, the user can absolutely not keep up. We all know this fact. I mean, it's not a moment after we've upgraded our phone or our TV that a few days or weeks later, a new one is available. But perhaps what's quite anecdotal is, when you're talking about can a user keep up, something which sort of stood out for me was Microsoft released some statistics relating to Microsoft Office Suite. So that includes Outlook, Excel, Word, and PowerPoint. And they believe that the average user using those Microsoft products utilizes 5% of the functionality available in those products. So one has to ask the question, is the user only utilizing 5% because they don't know about the other 95? Or is the user only using 5% because they are comfortable that that 5% actually performs the functions which they need? I don't know the answer to that question.
Yeah. I mean, it's interesting. I mean, if you don't mind me getting slightly personal, I remember visiting your house and you showed me your water irrigation system that you've sort of programmed yourself, and it goes on and you can set it and you can check it wherever you are, etc., which is great because you're a techie. But if it was me and I had that, I would probably have to pay somebody a fortune and then call on somebody every now and then to come and help me to sort the thing out because something went wrong. So, I mean, that's the personal side. When it comes to the business side, in the world of adoption in business and the uses of technology in the workplace, do the same rules apply?
Tony, I mean, we all know that technology is changing at rapid speed. We've been made aware of this by business analysts, by experts, by technology providers such as myself, that if you don't get on board with this revolution, that you'll be left behind. Although this may very well be true, an important consideration in the adoption of new technologies, or the upgrading of old technologies, for me, must always be the users, as they are the ultimate stakeholders that will make a technology a successful enhancement in a business or not. in my estimation, you can actually look at technology in business in two broad ways when you're looking to adopt or change your technology. Adopt or upgrade a piece of technology in your business. The first broad way is that you are actually utilizing the technology to remedy a particular specific pain point in your business. The second is where you look to adopt or upgrade a piece of technology or a technology stack in your business with a view to change the entire game. And those are two different approaches that you would have.
Yeah, so Tavia, sorry to interject you, just from a personal perspective, again, being a real techie, what is your honest answer? Which one do you prefer?
I prefer the latter. You have to do a game change, Tony, a full game change.
Okay, well, carry on. I'll come back to that.
Well, look at this. So with the first one, where you are looking to remedy, looking to utilize technology to remedy a specific pain point, the adoption in that instance is much easier for a user. You see, a user is more amenable to come on board as the technology, once implemented, will assist a user with a particular problem that they currently face. An example comes to mind where we recently assisted a company which was having an issue with cash allocations in various group schemes. They're a big business, they had lots of group schemes, and the solution required a full integration with their bank account in order to suck in all the transactions from their bank account into the system, which allows the users then to allocate the cash and the payments straight out of the system. And the users adopted this workload with happiness on their faces, as they knew that they no longer had the requirement to do a full report at the end of the month or a full bank recon. Items which took days to complete now were done the moment the cash allocation was completed.
So, so is that because they felt the benefit immediately?
They felt the benefit immediately. It was palatable. They could see it.
Okay.
The second option, which is, as I mentioned earlier, an alternative where you're looking to upgrade and you want to change the entire game in your business. And this proves to be more difficult, you see, because users, in my experience, are typically more reluctant to adopt a completely new way of doing everything, rather than just solving one or two of the operational pain points. Simply put, approaching a technology change with this view, though, will have a long-standing positive effect on your business over time. And the above company that I referenced earlier actually had decided at the commencement of the project that an entire overhaul of their business process and operations was required to allow them to stay relevant. So they chose a game change approach. With this game change chosen, they preferred to approach the system, and when they chose this approach, it opened up endless possibilities for them. In the above example, within a few months, it was noticed that the cash allocations that were such an issue before were now no longer an issue. So in fact, it became apparent that with the frequency and consistency of those cash allocations performed by the users, an opportunity existed to automate that entire process. Utilizing machine learning to replicate the user's repetitive actions, and with the help of AI, we were soon able to predict the allocation of cash deposits to the relevant group scheme with an 83% level of accuracy. The kicker here is that every month it continues to evolve. It gets better and better for those clients and users. But you see, the above example illustrates how users' attitude and approach to a system and technology change can be an entire game changer for the business. Once the step is taken that the system will allocate the cash and not the user, the system then can cascade the subsequent functions linked to that function in order to further assist the business and the user. In this example above, because the cash allocation was correctly applied, the relevant group scheme and calculation relating to the commission payable to the broker is automatically done as well. So now, once again, a process that took days to complete was immediately available. The user in this instance, Tony, feels the opposite of being left behind. The user feels emboldened with the knowledge that the technology is assisting with a problem that existed before that no longer exists anymore. So to answer your question, whether the user is left behind, the question more becomes a question of approach for me by that user and that business.
Okay, so many companies must, I mean, obviously, I have that challenge sometimes in my own business. Many companies sit with slow adoption when you bring in new technology. For us, it's CRM technology most of the time that provides a bit of a challenge. In your experience, where the internal business user is struggling to adopt, how do you go about then improving that adoption? Because you've got something, it's got lots of capability, and the user is only using a small part of it, or they're not optimizing how much the company can benefit from that software. How do you improve that adoption?
Tony, I mean, it's one word, it's training. I think one of the biggest aspects of any IT project is that there has to be a recognition that 70% of the success of the IT project, at least initially, is dependent on user adoption. And for a user to adopt, they have to feel comfortable. And for them to feel comfortable, they have to be trained. And they have to be completely, not an expert, but they have to have a good understanding of what they are trying to do on the system and how it all looks and works. Until they have that, they will struggle to adopt. And training has to be done more and more and more over time. It's not something that happens once off. It's not something that happens at the initiation of a project. It's continuous and it is recurring. It has to be, because technology is enhancing every week, every month, every year.
Mm. Okay, so now internally, I mean, you can do the training and you can, you've got a bit more control, especially yourself as the software provider. But what about the client, the end client, the policyholder? You obviously have to keep in mind where the client fits in and what the client would intuitively do. Like when you're in a parking lot and you're struggling to find, how do you get out of here? How do you get to the exit that you want? Not the one that goes out onto a main road, but the one on a side road, for instance. What do you do to help assist the client, but through that assist the business to get the client to adopt that? Is it the same as for internal design, same process?
Well, I think that if you sort out the operations internally, a lot of the customer-facing elements of your business become easier. A good example is, I mean, Discovery and the presentations that we had previously. I was super impressed with what they're doing because I understand the complexity in the tech stack which they use and all the data which they look to aggregate in order to give the client one version of one piece of information which is specific to that client. It's very impressive, and the whole journey of the client across all Discovery clients, for instance, is very consistent, and that's what you would want to try and get right in the adoption of any technology. And the users, i.e. the policyholders, they will be very happy to utilize a system or technology which gives them a consistently good customer journey throughout the entire life cycle of their relationship with that business.
Mm-hmm. I mean, many people in business will understand what the sort of a Peter principle is, where you get promoted beyond your capability. And that happens a lot in business and so on. But when I look at the Peter principle in technology, when it comes to existing technology, do we not jump the gun too quickly to build new when we have not optimized what we have yet? I mean, I use the example, I've used it before in a presentation with regards to Sapphire. I changed my medical aid to be able to fly Mango many, many years ago because I commute up and down so much. And the benefits that I got from Mango was better through my medical aid. But I eventually went back to Sapphire because Sapphire was so up on time. And they simply used, they went back to probably the first smartphone SMS, and they use that to keep people on time. In other words, they send you a message before the day before to say your flight is tomorrow at that time. In the morning, they tell you be there 90 minutes before the time because it's busy at the check-in. And then when you get to the lounge, you get a message 5 minutes before your flight starts boarding to say, you need to board now. That means that you don't have to try and find your gate, etc. They send you a message to keep you informed and tell you this is your gate. And for them, that was a game changer. So no big systems, etc. They used an SMS and it changed the game. They became globally the world's most on-time airline. So are we not jumping the gun all the time by trying to build new when people are comfortable in the existing work?
Yeah, I mean, ultimately, it's an interrogation by each customer independently. There's no hard and fast rule. There's no playbook. Some companies, it will be better for them to upgrade the existing technologies. Some of them will be better served by adopting new technologies. But ultimately, the idea behind any one of those choices has to be that you want to do a game changer approach in your business. And perhaps secondly, which is equally as important, is that any decision made should not be one based on operational efficiencies as much as it should be one that's centered around the client. Because if it's centered around the client, all the operational efficiencies will come because the technology now exists in order to make those operational efficiencies a reality. The technology is out there. It's really about how the secret sauce is how you position it for your client, how their journey looks. If you get that right, then everything else falls into place.
So I've got a question here from the audience that asked, based on your experience, so is there an ideal time to adapt and change from a company perspective, a best time to implement this change so that it is fully embraced company-wide?
You know, Tony, change is a difficult thing. Nonkululeko mentioned it, like how people wear a lot of anxiety during times of change. And what I've found is that ultimately what precipitates a change is that there is really a big operational difficulties, big pain points in a business that ultimately result in saying, look, we have to do the change. And maybe the approach should be that it must be more of a proactive one, where you it's independent of the kind of pain that you're suffering right now, as much as it is saying, if you take a 5-year view, what is my customer going to look like in 5 years? What's going to be the profile? What's going to be the age? How are they going to interact with me? How am I going to get my product to them? And I think those are the questions that have to be answered. And if those questions are answered in the affirmative and you have to change systems, you have to change systems. It shouldn't be a question of, well, our system's currently running for us now, that should be fine. Because if you leave it to the 11th hour, it might be very difficult to adopt and effect the change and get everyone on board in a short period of time.
I mean, so it's easy for the leaders because they understand the vision and the strategy and etc. Do you also proactively get the users involved before the time to explain what change is coming in and why, etc., to have them ready?
You have to, Tony. You have to. There has to be, as I mentioned earlier, a recognition that for the project to be a success, it's going to be 70% weighted in favor of user adoption. And whether the users like the technology, it works for them, whether it can actually assist them. So you have to get those users on board. And as I mentioned earlier, what I found is one of the best ways to get the users on board is to do extensive training. Because if they understand it, you're halfway there.
Brilliant. Tavia, we're running out of time, but thank you very much for...
Thank you very much, Tony.
Thanks for making yourself available. We've got the InsureTech conference next week, Tuesday and Wednesday, where we will have a bit more of a philosophical view on technology and insurance and looking at what is changing through technology in the essence of insurance and so on. So I look forward to seeing you there and debating those issues sort of on a more philosophical way. So for those guys in the audience who didn't know about the InsureTech conference, it's coming up next week. It won't be InsureTech as usual. It will be InsureTech Think Again. And we will be just unraveling those challenges with where we're going with the overwhelming amount of technological change. So Tavio, thank you very much. And thank you also for the audience and for InsureTalk for allowing us to have this conversation.
Thank you very much, Tony. Thank you, everyone.
Thank you so much, Tony and Tavia. We will be looking forward to more conversations like this one at InsureTalk, taking place next week. That does bring us to the end of our session. It's been an absolutely phenomenal one. A huge thank you once again to our headline sponsor today, Discovery, as well as our event partners, Cover Magazine, as well as the IISA. And then a huge shout out and thank you to all of our panelists today for sharing your valuable insights. We truly do appreciate them. A huge thank you as well to all of our attendees, you at home at the office, for your continued support of InsureTalk. We truly do appreciate it, and we would not do what we do had it not been for you. So huge thank you on that. A reminder once again to everybody that InsureTalk 15 will be taking place on the 26th of August. We will be sharing the link in the chat, so if you have not already registered, do the right thing and register now. In the spirit of Mandela Day, I would like to leave you with this famous South African proverb, Umuntu ngumuntu ngabantu. I am because you are. From myself, Nontutsuko Mhlungu, and the CN&CO events team, it's been an absolute pleasure. Enjoy the rest of your afternoon, stay safe, and see you at InsureTalk 15.